Good morning, everyone. Thanks for joining. Welcome to the How to Recession-proof Your Business panel webinar. My name's Amaya. I'm from Cheif, and I'll be moderating the session today. So just to take you through some general housekeeping before we get going, you'll be emailed the webinar recording either this afternoon or tomorrow morning, so there's no need to take any extensive notes. We'll also be doing a panel Q&A session at the end, so feel free to add any questions in the chat box. Let me know if you'd like it directed to a specific app or panelist as well. So introducing your panel for today, we have Mark Probert, who's managing partner at Agencynomics and Cactus, which is the UK's leading agency growth consultancy. We also have Nick Cole, Chief Commercial Officer at Float, which is a cash flow forecasting software. Next, you'll hear from Hannah Murray-Sykes, Head of Portfolio Marketing at Soldo, which is the expense management software. And then last but not least, we have Ben King, Head of Product at Cheif, which is the accounts receivable software and debt collection service. So to go through what we'll cover today, you'll hear an advisory overview from Mark. You'll be learning about recession, cash flow forecasting with Nick, expense management with Hannah, and lastly, optimizing your accounts receivable processes with Ben. So I'll now hand you over to Mark, who will take you through the advisory overview.
So I flew from Scotland to England last week. It wasn't actually illegal. I broke no rules, and I stayed in an area where lockdown restrictions were not in effect. What was apparent on this journey was this. The airport bus from near my house was not running at present due to no customer demand. The taxi through Edinburgh showed it was still a ghost town. Tourism not back, shops empty, offices closed. The taxi driver noted that before I called, he'd waited 4 hours for one fare, which was then a few miles for £9. The airport was empty, shops were making no sales, trams, buses and taxis were almost completely deserted. Departure boards showed just 2 pages of flights for the whole day, and the EasyJet flight was devoid of people. But the upside was I could easily get a coffee, a seat in the departure lounge, and my flight was on time. So always look on the bright side, right? So positive mindset, this is key for me. This overrides mostly all else. It can be very hard to stay positive, especially when you feel your business is on a cliff edge, but there are always positives to find. I'm very conscious today that today's audience is likely to be from a number of sectors, all of which have been affected by the events of 2020 in different ways. So apologies in advance that I can't cover all sectors, and that for some of you, what I chat through today may not be wholly relevant. So morning everyone, I'm Mark Probert and I don't have a job. Instead, I have a passion for helping marketing agencies scale their agencies. A qualified accountant, I work around the UK as a consultant, board advisor and CFO to some of the UK's leading independent agencies. Our consultancy, Cactus, is widely recognised as the leading specialist agency advisors in the UK. In fact, we have just won a National Best Business Award for outstanding support during COVID. I'm also managing partner of Agencynomics, a social enterprise dedicated to helping global agency people get access to knowledge and data. We launched our free community in April this year, and it's been humbling to see it become the UK's largest agency owner peer community so quickly. Our Amazon best-selling book, Agencynomics, on how to run an agency, is also still going strong globally. So, why did Cheif invite me to speak today? I did question this actually. But with over 20 years experience advising companies of all sizes, both in the UK and overseas, the last 6 being specific to digital marketing agencies, and having worn many different finance hats over the years, I have the dubious experience of having been through recessions before. I also help agencies on an ongoing basis to plan out their future, vision, roadmap, budgeting, cash flow, etc. So Chaser asked me, how would I recession-proof my business? Well, I'll leave debt collection, detailed cash flow forecasting and expenses management to the other experts on this webinar. I know some people are anti-borrowing and feel, well, we're all having to pay for this debt at some point, But parking those moral or ethical points, here's what I would do to protect my business. I would basically forecast Armageddon, or COVID as it's now obviously commonly known. I would sit down with no distractions. I would completely focus on planning out my worst case cash flow. No more sales, no more government support other than those you would definitely receive. I would paint the bleakest picture that I could. I would include all my expenses as I've been incurring them. I would include full rent, service charges, and full payment of all taxes on time, every time. I wouldn't plan any upside. Then I would step away, I'd go for a break, and importantly, I wouldn't turn to alcohol, because what I've just painted is the worst case scenario. So positive mindset, there I go again. Well, yes, some of us are pessimists, often the accountants, and I'm sorry, it's a bit of an in-joke there for the accountants on this call. But now you know what the absolute worst case is. Surely, in the words of 90s pop group D-Ream, things can only get better, and I promise I'm not going to sing. So it's time for a mindset change, in my opinion. So what I would do is I would reforecast reality. When is the last time that you actually sold nothing? Think about that. I know for some businesses at the moment, the answer is every day, and it pains me in some ways to raise this point. But for many businesses, the answer is hardly ever. So my suggestion is this. I would build out another cash flow scenario that predicts some revenue, perhaps based it on the last few months. I would factor in what my pipeline is saying. So for example, for our agency clients, we use our own agency-specific Cactus pipeline tool. And then I would review all my costs. I would review every expense area and I would cut my cloth accordingly. I would cut out the unused subscriptions, which are always there. I would use the cheap finance on offer out there to lease or hire purchase any new kit. And I would consider whether I actually really needed it. And I would negotiate all my supplier contracts, but I certainly wouldn't take the mickey for those suppliers providing exceptional value. I would remember that landlords are actually human. Don't be afraid to approach your landlord to discuss options on rental discounts, deferrals, release of rent deposits to cover future rent months, and reduce service charges, etc. Most landlords our agency clients use have been willing to listen and have been negotiating, as they too are worried about losing the longer term income of not having tenants. For any landlords listening, I truly hope that Rishi delivers a supportive scheme for your sector in the near future. I would then take the funding. The government-backed loans, the bounce backs or the C-bills should be taken, in my opinion, without security if you don't need the additional amounts beyond the non-securitized levels. And remember, you can still claim these loans up to the end of November. These loans are the cheapest borrowing you will likely ever receive. If you haven't taken these loans already or don't know what they are, I'm happy to take questions at the end or just email me. I say take the loans as there is no necessity to actually keep the finance longer term. If you don't ever spend it and don't like debt, I suggest take the loan, put the money in a separate bank account, and in a year's time, remember they are both completely free for a year, repay them. The government has just extended the borrowing terms to 10 years on both, so don't forget to clarify this with your funder if you've already taken, and map out the reduced monthly repayments in your cash flow. And a note here, the government announced it will give more details on a new loan scheme coming in January 2021, so one to watch out for there. I would review my VAT position. Are you invoice accounting for VAT, i.e. potentially paying VAT to HMRC before you receive the money? Do you still need to be, given the impact of COVID on your sales? Check out HMRC's VAT guidance for the change of scheme rules, for example, 1.35 million sales run rate. Perhaps you can change to cash accounting, i.e. you only pay HMRC after you've been paid. Thus, for many companies where sales VAT exceeds purchases VAT, this can be a real help in deferring cash outflows. Also, Rishi announced 2 weeks ago a further deferral of the COVID quarter VAT if you had a liability for that period. So instead of being repayable by the 1st of April next year, this can be spread over a further 11 months to make sure your cash flow reflects this. I would pay on my terms. Now, I don't mean screwing over suppliers or team members here. A number of agencies I know have agreed with HMRC time to pay arrangements, spreading VAT, PAYE, corporation tax over a period of months to help their cash flow. I've always found HMRC to be willing to have a sensible conversation about this, even more so in the recent months. And whilst I'm not advocating dodging any taxes, I would recommend having a discussion with them. I would be armed with a sensible plan for cash flow spreading, one that you won't then default on. Some folks say it takes hours to get through on the phone to HMRC, others don't. But that wait is much more worthwhile than spending hours of sleepless nights worrying about cash flow. A number of clients have asked me recently, should we pay back HMRC before our agreed payment plan to show good faith? My simple answer is no. You have agreed a payment plan, so just stick to that and everyone is happy. Just remember, cash is king. Beware the false dawn. Profits and excess cash don't always equal reality. Many businesses are swimming in a false sense of security at the moment. For many, the furlough grants have masked the harsh reality that the business does not have the income to support its cost base, and yet monthly accounts are showing a profitable position. That, combined with an influx of cash, loans, grants, furlough, rates relief, can also mean a business suddenly has excess cash floating around. It sounds strange to say this, doesn't it? But it's actually true. So don't let the false profits and false cash lure you into thinking all is rosy. Forecast the repayments. Remember, you have to repay the loans and the taxes at some point, albeit the accounting body, AAT, and George Osborne, the ex-chancellor, are leading the charge on trying to lobby government to at least fully write off the bounce back loans. So one to watch there. I would double my marketing spend. It's been proven in recent past recessions, that those that thrive tend to be the ones who invest more heavily in marketing. Does anyone here remember the 1920s? Do you remember the cereal maker Post? I bet you know Kellogg's though, and they're the ones who doubled down on marketing Rice Krispies. Perhaps it sounds alien to hear an accountant say spend more money, but more leads should equal more sales, obviously with the right targeted marketing. And hence, assuming you credit check properly and have Chaser installed, more cash coming into the business, thus helping you to prosper again. Now, if you don't know how to conquer Google, etc., I would suggest speaking to a local marketing agency to see how they can help you. So you can help them to help you to help the economy flourish again. And I would also use my taxes to make cash. This is a topical one here, given the recent news about Donald Trump's tax returns. With the accounting losses COVID may have brought many businesses, the old trick with losses used to be to shorten your year end where possible and claim tax relief on those losses and potentially get a refund of corp tax that you might have paid previously. The government has recently allowed companies to advance submit these losses without changing your year end. So perhaps this is an area to speak to your trusted accountant about. One area I still surprisingly see overlooked by many businesses is R&D tax credits. This HMRC approved scheme is so helpful to providing either reduced corp tax or actual cash refunds when a company is carrying out technological innovation. The misnomer I often hear here is that this just applies to companies who build technology, but this is not true. If you aren't already exploring R&D, then just message me after and I'm happy to introduce you to an R&D specialist to have a chat. Now, HMRC is turning claims around pretty quickly at the moment, but you must submit a year-end set of accounts, which if this isn't happening soon, you can always shorten your year-end, as I mentioned above. So in summary, what would I do? I would forecast Armageddon. I would keep a positive mindset. I would reforecast reality. Remember, landlords are human. I would take the funding. I would review my VAT position. I would pay on my terms. I would beware of the false dawn. I would double my marketing spend without a doubt. And I would try and turn my losses in R&D into cash. So thanks very much for giving me your time today. I'd like to hand you over now to Nick, my friend from Float, the cash flow experts, and he will take you through cash flow forecasting during a recession.
Thanks, Mark. Lots of useful tips as usual from you. You need to listen to Mark, he really knows what he's talking about. So I'm going to talk to you a little bit about cash flow specifically, and a little bit about flow sort of within that realm. So moving forward, what actually is cash flow? I managed a business, an agency actually, ironically, before joining Flow 20 months ago. I'm not an accountant, but my understanding of what cash flow is that it's essentially the flow of money in and out of your business. And as many businesses are currently finding, it doesn't take that many weeks or months of not having cash before businesses may find themselves in trouble. If you've got less coming in and have still got money that needs to go out, then you're potentially going to be in trouble. Ultimately, you can't pay bills with theoretical money. You need the cash in the business, and you need to understand the source and the certainty of that income and map that against the outgoings, as Mark just suggested. There were some pretty scary statistics that came to light during the, I guess, first lockdown between March and May. So according to ONS, 5% of UK SMEs had no cash reserves whatsoever. More than 20% had absolutely no idea about what cash reserves they had, and less than 25% had 6 months of cash. So it's no surprise really that there's a lot of stress out there around the subject of cash flow. You may well be thinking, well, I'm okay, I understand my business, I've got everything covered, I've got my C-bills loan, I've got my B-bills loan, I've got a plan. My question to you would be, do you ask yourself things like, can I afford to hire? When should we pay this bill? What if this invoice is paid late? That was a big one for me in agencies. Do I need to get a loan to cover payroll? What if we lost that customer? Did I overspend last month? Etc., etc. If you're finding, like I was, that I was asking myself those questions pretty constantly, then a cash flow forecast can absolutely help answer those questions. That was pre-COVID. And running a business now, there are umpteen more questions of more urgency even than this. There is a statistic that we often quote in our cash flow world. It's potentially contentious, but 82% is a number that is very often reported as the number of businesses that reportedly go out of business due to cash flow difficulties. Now, many of these businesses might not have a good business to start with, but one thing is for sure is that understanding and monitoring your cash flow is the most important thing that you could do for your business, especially right now, because if you don't monitor your cash regularly and reliably, you are definitely putting your business at risk. And this statistic, however accurate it is a really high number. So definitely a cash flow forecast will help. Having an accurate budget, having a cash flow forecast in place, and the ability to scenario plan, which I'll talk about a little bit more in a minute, can really help you quickly and accurately answer all of those questions and more, no matter what your business is, whether you're an agency, whether you're in hospitality, whether you're in the travel industry or construction industry. You'll have your own questions and you'll have your own financial problems. Having these three things, that budget, cash flow forecast, and scenario plan in place, can absolutely help provide that peace of mind to let you understand and have some confidence as to what that future cash and financial picture looks like. The analogy that one of our accounting partners uses, which is my favorite way of looking at things, is cash flow forecasting is often seen as quite a reactive, quite a negative thing. I'm okay. Actually, I've got a bit of a cash crunch. I need some help. I need to get a budget and I need to get a cash flow forecast. That's really reactive. My feeling on this, and I know Mark absolutely shares this, this point of view, is that you should look at cash flow forecasting and budgeting very much as a prevention piece rather than a proactive piece rather than a reactive piece. The favorite analogy that one of our accounting partners uses that she shares with her clients is that think about driving a car. If you're driving a car, that you've got the engine under the bonnet purring away, and that is your accounting software. And if you're a car owner, you don't really want to be under that bonnet a lot. You don't really want to be in your accounting software. But it's very, very important that you can see where you're going, that you can see clearly down the road, you can see obstacles in front of you in enough time to be able to do something proactively and positively about that. And if there's anything going wrong with that engine, some lights will appear on the dashboard in enough time for you to be able to do something before that engine blows up. So I really like that analogy of thinking about, well, look, this is a preventative thing. This is a proactive thing. I'm going to get out in front of my numbers and I'm going to understand what is coming at me before it happens. So specifically, what is float? Well, float is a visual operational cash flow forecasting and management software. And what I mean by that is that it's live, it's easy to understand. If we can move on to the next slide. Thank you. It's really easy to understand. It's reliable. It's fed from your cash flow. It's fed from your accounting software. And so if you are seeing this, if you're in a business and you're actually seeing this when you could be seeing this, then you've got to be a massive, massive Excel freak to want to see that first picture versus seeing this picture. So what float does a lot of the heavy lifting in the background. So rather than you having to update a spreadsheet, to see that spreadsheet, float does a lot of that heavy lifting. So float allows you to clearly see when you'll run low on cash. It's very straightforward. It's very easy to use. It's designed for business owners, not necessarily accountants, to be able to use. You can set your budget. You can clearly understand then, based on that budget, what your cash position looks like. You can set a threshold in float so that float will flag to you when you're going to fall below a certain cash amount. Now, whether that is in the red, whether that is a certain cash positive, you might have an overdraft in place, you might have taken out a receivables or a payables loan, like Mark just mentioned, that you're treating as your cash reserve. You can plug that into float, and float will proactively tell you, as you can see from this graph, when you're going to fall into the red or below that cash threshold. My favorite piece of float, and one of the features that our users love the most and use the most, certainly during COVID, we saw this a lot, is our scenario planning tool. And I've always thought of this as a what if piece. It's a what if scenario. What if this happens? What if that happens? You can find out the cash impact of those future plans. So what if I win this new project? Can I afford to hire someone to cover that? What if my biggest client pauses? There's a lot of that, certainly in the agency space, but in the construction space, we're seeing impacts again. I live in Scotland. We're seeing impacts again of lockdowns happening, for particularly going to impact the hospitality business. Those hospitality businesses may have had a plan of, right, okay, October, I'm going to expect this much in and this much out. That plan changed yesterday. They've got the next 16 days within the central belt of Scotland with their doors shut. So it's really, really important to have something that's live, that is being fed from your accounting software. So as you are reconciling transactions or your accountant or your bookkeeper is reconciling transactions in your accounting software, this is feeding live into float. It's giving you an up-to-date, accurate, trustworthy decision-making picture of what you can, can't, should, and shouldn't do. So really understanding the ins and outs is also super important. Float imports all invoices and bills, as I've said, every day from your accounting software. You can see where all your upcoming payments are, when they're due. You can update the date when that cash is expected to be paid. So if someone has told you that they're not going to pay you until 2 weeks later than they said they would. You can plug that in, you can change that in Float, you can see what the impact of that looks like. If a business that you're working with has gone out of business, you can toggle things off to see what impact that has on your cash flow. You can also then join that decision making up with how and when and what you are paying in terms of your outgoings. So often, and I've definitely experienced this, you're paying things over here and not receiving things over here. And that's when you can get into cash flow difficulties. And certainly this feature in Float fits and sits really, really well with Chaser, for example, as a sort of next level. You know, if you're struggling to bring that outstanding debt in, then Float will flag that to you. And then potentially you can use Chaser to do that, to do that chasing piece for you. You can explore budgets versus actual. So in base terms, what was I expecting to come in and what was I expecting to go out versus what has actually happened. Float allows you to dig in on a category by category basis to understand, well, actually, I spent more last month than I was expecting to. How did that happen? Where did that happen? Well, actually, I spent more on staff, or I spent more on marketing. Mark was mentioning that marketing spend at the moment is a good plan, and I totally agree with that. You can play around with those scenarios and pull this into your budgets versus actuals to see, well, what is the impact of that? What can I afford to do? Float also allows you to get into really granular detail. So you can see day by day what is being paid, what is coming in, what your cash position looks like. You can set date ranges if you want to see a week, if you want to see a month, if you want to see a quarter. All of this is allowed. There's a flexibility in Float that allows you to break all of this down. So, for instance, those businesses, those hospitality businesses in Scotland might want to look at what the next 16 days looks like, or they might want to look at what November looks like on the back of that additional lockdown that's happening up here. So that's a real deep dive into what Float is and does and why it's definitely, for me, much better than a spreadsheet. The live nature of Float is what you need right now when the milestones are and plans are moving. Float's been around a while. We're not a new kid on the block. As you can see, we've won lots of awards. That's all very nice and well and good. It hopefully says that you can trust our software. It's secure and robust and accurate and reliable. All of those things that might sound boring, but you absolutely need when it comes to cash flow. And I'm going to leave you with a review. We've got lots of reviews that come in all the time, but this one came in from Sarah Sadler in April, and I loved it. And she said, "This is a difficult time. It's such a hard time right now for most business owners, whatever is happening for you. In this midst of this pandemic, one thing alone keeps me sane, and that's Float. Being able to see at a glance where we are, see the potential effect of a decision by creating scenarios, fantastic software, fantastic customer support." So that obviously is why we exist. And right now, Float can definitely help you get through this pandemic, plan for that future. There's going to be a long tail on this thing. So give yourself some comfort, get yourself a good accountant, and use software to help you get through this. Thank you. I'm going to pass you over now to our friends at Soldo.
Thank you very much, Nick. Hannah here from Soldo today. You may notice that my voice sounds slightly different to what you might have expected based on some of the marketing. I'm just stepping in for my colleague Leigh today. I'm head of portfolio marketing at Soldo, and I'll be speaking to you about spend and expense management and how you can use this to your advantage to recession-proof your business. So I don't think this stat will come as a surprise to anyone. We spoke to just over 100 finance leaders about their biggest challenges, and 72% said that cash flow management was their greatest challenge, and that was far, far ahead of any of the other options in the list. The most interesting thing isn't actually the stat, because I don't think anyone would be surprised by this. The most interesting thing is this was actually done in February, so just before the pandemic hit and kind of panic set in. So this kind of suggested that finance professionals were actually leaning towards safer short-term strategies even then, but also suggests that a lot of finance and accounting professionals aren't yet fully leveraging the type of technology and automation available on the market and that we're hearing about today. And when we talk about cash flow management, a lot of us think about forecasting that we just heard about. A lot of us think about supplier management. We think about accounts receivable that we're going to hear about next. But what we find is actually, and coming back to what both Mark and Nick said about preventative measures, is that other side of cash management that people don't necessarily think about quite as much. Something that we think of as controlling the controllables. So we looked at kind of behavior from our customers between March and April. And looking at just under 30,000 businesses, we found that business spending dropped 41% in April compared to March. Now, this, again, that wouldn't come as a massive surprise. As everything changed, people started talking about a recession, businesses started to tighten their belts. Their priority quickly became cash preservation, and when that's the case, you start with your variable costs. Those fixed costs, the overheads, capital expenditure, that's something that is going to be harder to have an immediate impact on cash. Businesses have to start seriously looking at staff, applying to the government grant schemes we've heard about, and unfortunately turning to redundancies. But anything you can forecast accurately, at least you know what you're dealing with. Those variable costs, however, expenses and spending that happens outside of what you can forecast and track, the ability to control this that is really important, and the impact that it can have on cash is very high. So what a lot of businesses did was they looked at, okay, how can we completely change our processes straight away? Moving to zero-based budgeting, for example, kind of bringing that back from a few decades ago, or completely stopping cutting spend in certain areas. We were just talking about the fact that actually cutting marketing spend can cause more damage than good to your business in some cases, but a lot of businesses just thought, right, we just need to cut these areas of spend until we're confident that we're going to have enough cash to survive. So for a lot of these businesses, they've found that this was an opportunity to reevaluate their spending. Many don't know enough about what these variable costs are until that credit card statement comes through at the end of the month. Those employees file their expense claims, ideally at the end of the month, but often 2-3 months later. And actually a lot of business leaders admit that they do know that a lot of their spend isn't actually aligned to the company's strategy and goals. This is understandable. A lot of this spending is necessary to moving the company forwards. Now, obviously, you'll see on this image travel and those kinds of expenses definitely were not people's priority back in kind of March through the summer. But a lot of companies turned to software subscriptions, making sure that they had the tools to be able to work from home and successfully work when not everyone was in the same place. A lot of companies were having to turn to petty cash more and more. We work with a lot of care homes, a lot of charities who needed to be able to spend immediately to be able to get their residents, to be able to get the people that they were helping and the money they needed in order to be able to run. So a lot of this spending definitely necessary to moving a company forward. You could consider it to be tactical, therefore not something you can forecast annually in advance, and a lot of the time each individual cost isn't significant enough to warrant a complex sign-off process, but it does all start to add up in the end. And there is a good reason why controlling this is very difficult. So it involves multiple people, departments, locations, needs to satisfy different needs. Like we said, often can't be planned in advance. It's a struggle just to understand what's happening and often results in nasty surprises that have to be dealt with later. And a lot of this is because there is no way to delegate the execution of payments. Again, this isn't something that is an issue with businesses, it's the issue with the tools they have available to them. Banks can't provide granular access to money. To maintain control, you have to centralize everything, which means that there are bottlenecks, and there's no way of setting kind of different levels of permissions. The example that we always give is would you want to give the intern access to your bank account in order to make a payment? Very unlikely that either party would want that to happen. This all results in very inefficient and costly manual processes. So finance and accounting teams, even business owners, lose days to manual processes. Kind of everyone knows what it's like to have to chase receipts, categorize and recategorize transactions, validate expenses against policies, budgets, reconciling those receipts and invoices, getting that data into your accounting system so that then you can actually have that view of what's happening. And all this results in very poor visibility and definitely no real-time tracking for that type of spend. This spend tracking happens weeks, months later, at which point there's not really much you can do in terms of preventative measures or using any of that data to support decision-making. It's all looking backwards when the most important thing at the moment is to be able to look forwards, predict that cash outflow, and making sure working capital isn't negatively impacted. So Soldo essentially exists to help solve this problem. We look to try and help businesses become more agile, making them more able to deal with the ups and downs of a recession, giving them complete control over their spending and ultimately more control over their cash flow. So the idea is that having scalable processes and systems in place means that you can adapt faster, and then when it's time to spend again in the right areas, you don't have to slow down your business when there's those potential growth opportunities. So it kind of goes all the way through from having that control right up front of being able to manage your budgets and authorize spend in as easy a way as possible. Defining and controlling access to money so that you're actually able to delegate to the right people in your business who need to spend, and then turn that into the ability to delegate the payments themselves, which ultimately results in efficiency. By delegating this to people, you're also asking them to automatically follow your processes, capture that context, and enrich that transaction data so that you don't have to chase it afterwards. Meaning that, again, that control, and when the control comes back, you're able to validate that information because it automatically fits with your business policies. And then finally, kind of back to the point around efficiency, be able to integrate all this information into your accounting system for reconciliation, but in order to be able to see this information in other tools, for example, when you're doing your cash flow forecasting. Because it all comes down to having that visibility. I think that's what all of us are talking about today, that the visibility is the most important thing if you want to be able to adapt and move quickly. So what do I actually mean by all these things? So the way that Soldo works is that our platform goes all the way through from MasterCard cards that you can give out to your employees, which once you've given those out, you're able to do things like set those budget controls and transfers to those cards in line with your policies and what needs to be done. So all starts with budget setting, who has access to money, and making sure that you can control exactly what happens when the top up happens and how those budgets are set. Then you can kind of go into more granular detail if it's the type of thing that would suit your business. So setting bespoke rules for each person who's able to spend. So manage the ability to withdraw cash, for example, the ability to spend online or abroad. A lot of our customers go into quite a lot of detail around the categories that people are allowed to spend on. If you are going to be buying software subscriptions, then you obviously don't need to be able to spend money at a cocktail bar. So you're easily able to switch on and off those permissions so that people are spending in exactly the right places. When we're talking about kind of the issue with the way that the banking system currently works, this is an easy way to delegate those payments without giving access to bank accounts, relying on email approvals, then kind of dealing with all of the issues later on around credit card purchases or out-of-pocket spending, which means that you have to deal with complicated reimbursement processes that aren't something that your employees actually want to have to to deal with. So an easy way to quickly transfer money to your employees in line with those policies you set and those budgets that have been agreed. Then when it comes to actually spending, because everything is connected, someone spends £68 at Tesco. That was a category that they were approved for and they were allowed to spend on. Because everything's connected, they immediately get a notification on their phone telling them to capture that receipt and to add any tags, codes, notes, information that you have asked for as part of the original setup. You're then able to see all of that information live. So as a transaction happens, you can see that in our system, which means that if anything's happening that shouldn't, you can catch it straight away. But also you don't have to wait until the end of the month to do that reconciliation and to see the impact that this might have on cash. So you have all of that information in one place, ready for your accounting systems, but also categorized and ready to be analyzed to feed into your planning and into your forecasting. Something that we think is really important, looking at kind of taking time for that spend analysis, seeing what the behaviors and patterns are by user, by department, by category, however your business is structured, to be able to feed that into your decision-making and other areas of your business. Thank you very much. That was it for me today. I'll now hand you over to Ben from Cheif, who will take you through optimizing your accounts receivable processes during recession.
Great, thanks very much, Hannah. So good morning, everyone. I'm Ben. I'm the head of product here at Cheif. Cheif, if you don't know, is the market-leading accounts receivable automation software. So we help businesses automatically and intelligently chase invoices to get paid sooner. So I want to start off today by talking a little bit about the late payment problem more generally. So late payments are a problem for many businesses that sell on payment terms. Xero's research with PayPal in 2019 actually found that on average, 48% of all invoices are paid late each month. And research in 2016 found that in the UK alone, SMEs were owed over £225 billion in total. This obviously has huge implications for a business. To name a few, unreliable payments, unreliable and late payments can mean difficulty forecasting, as we've seen. It can stifle business growth, it can slow job creation, and can create a dependency on debt and equity financing. There's also the time wasted when chasing up late payers, which is such a valuable resource, especially for any SMEs. We know that on average, SMEs spend about 336 hours per year on accounts receivable tasks, which is often time that can be much better spent elsewhere in the business. It's no surprise then that late payments unfortunately cause thousands of business failures every year. 2016 research found that in the UK alone, late payments are responsible for 50,000 SMEs closing each year. These problems are not exclusive to SMEs either, with 70% of CFOs at large companies viewing late and non-payment as a threat to their businesses too. But late payment and the problem they cause has become even more prevalent in the midst of a global pandemic and economic recession. The late payment problem has become far worse, with the CPA noting that the global numbers of late payments has increased by 209% since the pandemic was declared. Unfortunately, the reality for SMEs now is that they have a reduced headcount, leaving remaining staff stretched for time already with more responsibilities. Meanwhile, getting cash in to maintain a healthy cash flow is now more important than ever in order to withstand the impacts of the economic recession. So I implore you to look inwards. So what's the situation at your business? Are your customers paying you on time? Are you chasing up and dealing with late payments? And do you really have time to be doing this as effectively as you could be? Lots of businesses are turning to us at Cheif to automate their accounts receivable process in these difficult times. Today, we've already supported users in chasing over $3 billion in overdue invoices. With the levels of customization built into the software, you can completely automate the chasing and management of overdue invoices, whilst maintaining great relationships with your customers during this time of uncertainty. Cheif's software automates the accounts receivable process and speeds up debt collection to help users get paid on time in less time. Cheif integrates with your accounting software to automatically and intelligently chase overdue payments you want it to. It uses customizable payment reminder templates, which are fully personalized to each recipient. These are sent according to chasing schedules, which you can edit and add in as many reminders as required to optimize and suit your business needs. The flexibility Chaser offers users means you can easily set up multiple different schedules. For instance, many of our users recently have been setting up payment plans and tailored schedules to chase installments for those groups of customers who may be struggling to pay during the recession. Chaser gives users access to a receivables section, which provides a CRM-like view of your accounts receivable, consolidating all communications for customers and their invoices. This includes things like Chaser's sent, any email responses from customers, and logs of phone calls and notes to other team members, as well as a risk and reports and insights on your accounts receivable and customer late payment risk levels. Our users on average get invoices paid 16 days sooner and experience a $22,000 cash flow boost for every $500,000 of business turnover. And our users have saved over 15 hours per week on their accounts receivables tasks. We've received great feedback from our users. For example, from fashion wholesaler Love Brands, who now save 15 hours per week on their credit control, and Hub Property Care, who saw the positive impacts of Chaser on their cash flow from day one. From the great work we've done at helping SMEs to get invoices paid, Chaser now has 400 reviews and a perfect 5-star rating, with the highest rating accounts receivable app on the Xero Marketplace, 4th highest rated app in the entire Xero App Marketplace, and Xero App Partner of the Year in 2016. If you, like many businesses, are struggling with less resources and more payments to collect, Chaser provides a low-cost way to help recession-proof your business with better cash flow management. It integrates with key accounting platforms, Xero, QuickBooks Online, and Sage Business Cloud Accounting. You can use it to automate and run a more efficient and effective accounts receivable process for as low as $35 or £25 per month. We also offer all users 14 days free trial with no obligation, so that you can ensure Chaser is the right solution for your business. I'll hand over to Amaya now for the Q&A.
Thank you. So as Ben said, now's your chance to drop any questions in the chat box and I'll get the panel to answer these. As I said, do let me know if you'd like these directed to a specific panelist or a specific app, so I can make sure you hear from the right person. Okay, so Ben, it looks like we had one come through for you actually whilst you were talking. It says, how many payment reminders can you schedule for an invoice with Chaser? A lot of our customers need more than just 5 reminders.
Yeah, sure, great question. So at the moment in Chaser, each schedule, you can have up to 10 reminders per schedule. So that can be a combination of before due and after due for that invoice. However, you can also, in your schedule, actually set up a repeating reminder. So what that means is after it's gone through the current schedule, then it will just repeat the last reminder for however long you like. So effectively, you can set up as many as you like, but the 10 different reminders per schedule.
Great, thank you, Ben. We've had a couple come through for Nick here. So is there an introductory offer for Float? It looks good and I would like to try it.
We have a 14-day free trial available. So if you go to www.floatapp.com, then you can sign up for a 14-day free trial. As a business owner, you won't be asked to put your credit card details in up front. We have a lot of onboarding help and video help, and we've definitely found that 14 days should give you enough time to feel your way around, connect your accounting software, and see whether Float is going to work well for you. We have online help, so we have actual human beings available then to chat to as well, if you want to reach out via the app or the website.
Great, thanks, Nick. There's another one here for you as well. Can Float manage forecasts for companies that have more than one entity? I really struggle forecasting with automated tools, given the added level of complexity of multiple entities.
Yeah, that is a question that we hear a lot, and actually, unfortunately, the answer at the moment is we don't manage multi-entity. We don't have consolidation built into float, but it is something actually that we were having a meeting about yesterday in terms of prioritizing. There are workarounds there. You can use float and then you can export individual entities out of float into a spreadsheet, which may seem counterintuitive, but at the moment we do have customers that do that and still find really good value from float doing that across multi-entities.
Great, thank you, Nick. Mark, there's a question here for you. It says, Mark, do you know what proportion of agencies have been taking the government loans?
I don't know the exact percentage, but I suppose our community's got around about 800 agencies in it, in the UK and Europe and actually further afield. And the ones in the UK on my clients, it's probably 9 out of 10, I would suggest. And okay. if they haven't, I was with somebody actually on Monday, and they hadn't taken the loan, but they were sat on quite a lot of cash reserves. But they actually decided at the end of the board meeting to take the bounce back loan because of the point I made in the presentation about protecting themselves to the slightly longer term. They're just going to park it and then pay it back if they don't need it, or invest it in something.
Yeah, we've talked about that before, Mark, haven't we? In terms of taking that loan and it not necessarily just sitting in a shoebox, so to speak, is actually think about that. The value of those loans and how you can invest that. And you'd mentioned marketing spend, or you'd mentioned sort of other areas where you can actually positively use it. I think
one of the topics of debate has been that if everybody's taking these loans, what's going to happen to the economy?
Yeah.
Well, parking to one side whether they get written off, which is, as I said, what some of the accountancy bodies are lobbying for with the bounce backs. There are a number of companies, I work with some of them, that aren't using the money. It's parked. Yeah. Now, whether they keep that in the longer term or whether in 12 months' time there's suddenly a flood of cash back into the government's pot, because that could well happen if people don't want to retain the funding. But I mean, that funding is so cheap that in some ways, why would you not take it?
Yeah. We work with a lot of accountants across other sectors as well, and we've definitely found that a majority of the accountant partners that we work with are recommending really similar things to you, Mark, for agencies, for other businesses and other sectors.
Nick, I have another question for you that's come through. It says, we've applied for a number of grants and loans due to COVID, but we're not sure if we'll get them or which ones. How do you recommend forecasting for this? Can float help?
Yeah, so I mean, you can basically plug those in. That's where the scenario planning really comes into its own. So the way that the scenario planning works in float is that you have your base budget. And what you then do is you can layer on theoretical scenarios. So you can you could add all of those things into your budget lines over the relevant time period, and understand what the impact of adding X or Y or X and Y. If there's multiple loans and multiple grants that you've applied for, this really sort of goes back to, again, what Mark was saying, is you've got your baseline, you've potentially got your doomsday scenario, you've got your actual scenario, and then you've got multiple theoretical scenarios of, well, if this happens, if we get this loan, if we get this grant, then what does that do? You can be very, very granular with that scenario planning. So once you've added that loan to a scenario plan line, you can then compare. So there is scenario comparison functionality in float where you can see and compare, grant versus loan or loan plus grant. And you can then start plugging in, well, okay, if we then spend X on marketing or Y on staff, what does that look like? So it's super, super flexible.
Great, thank you, Nick. We've had this come through. It says, more of a comment than a question. I'm a massive fan of Chaser. They have saved me so many hours and made life much easier. Highly recommend to everyone on the call as a finance director. Thanks very much to the anonymous attendee who added that in. Very kind words from me and Ben.
Are there any equivalents for Soldo, for Flow, or for Agencynomics and Cactus there? Or?
If there is, I'll be sure to remember. Guys, keep them coming. We're loving the compliments. So, Mark, there's a question here for you. It says, Mark mentioned the mission vision to setting business priorities to forecasting process. Would love to hear what resources, if any, he would suggest for businesses doing this for the first time.
Oh goodness, this is a big question. do they mean from a financial sense or a general business sense? It doesn't really say, does it? Just very briefly, because mission and vision is obviously a huge topic. It's probably a whole other presentation, but some of the systems out there that I know a number of agencies use, I'm not going to say whether I agree with them or not, but some agencies use the EOS traction, get a grip model. Gino Wickman books. There's a lot of a toolkit there you can access online. EOS, that gives you a bit of a framework for working out your vision and your mission. Some of the other tools that we often look at a business model canvas. So if you go on, I think it's www.strategizer.com, I think is where you get a template for business model canvas, and it gives you some pointers as to how you can sort of look to work out your mission and your vision. But I mean, that's a huge topic in terms of forecasting around that. I think is the question. Do you think perhaps what we'd love to hear is how you go about forecasting? Is that maybe the question, Amaya?
Setting business priorities to the forecasting process. I'd love to hear what resources, if any, he would suggest for businesses. I'm not quite sure, to be honest. I
think maybe we could ask, maybe you could ask whoever wrote that, just to be clear if they mean from a financial sense, because if they do, then I mean, ever the accountant, I suppose there's a spreadsheet somewhere in the middle of most things. Hopefully it's not Excel if you're the government at the moment, but you know, there is, in terms of forecasting, I think there are tools that you can use in terms of add-ons. There are other you know, apps that aren't on this call that do certain things quite well. They do dashboarding and so on, but from a pure forecasting sense, I think, you know, I've yet to see somebody not use a spreadsheet to do the initial bit of that, if that's what they mean.
Mm-hmm. Okay, cool. Thanks, Mark. Nick, another question for you. How is cash flow forecasting different to my P&L budget? Why do I need both? Maybe Mark as well. That might be a good question for you too.
Yeah, I mean, we're obviously asked this a lot, and you know, Mark's probably got a better answer as an accountant, but certainly what I can talk to when I was running the agency, and that we were often presented by our accountant with P&L forecasts, and the challenge with that is that it isn't really real time, and it doesn't tell you what the actual cash that you've got in or don't have in. So in terms of like decision making within, you know, quite spiky cash flow businesses like the one that I was operating in, and probably like most businesses right now, you want that real-time cash-based cash flow forecast, rather than it being a sort of longer-term, bigger picture profit and loss forecast. You want to know what you've got and what you don't have, and what you can spend or should spend and when. I'm sure you've got more technical terms to add to that.
Yeah, I'm sure, Nick. Yeah, I suppose I often get asked this question, and trying to keep it simple, I kind of give a £100,000 project as my example. And what I mean by that is, an agency wins a £100,000 project. They think they've got £120,000 in their P&L, because often I'm generalising a bit, but they think that it's the gross amount. So suddenly they've got £120,000 in the P&L, and they suddenly think everything's rosy in the bank. But obviously that 120 doesn't come into the bank often for 60 days if you're working with the bigger brands, albeit obviously if Cheif and that are on the case, it might be shorter. But you know, that 120 isn't your P&L, it's 100. The 20 is owed to the VAT guys, and you've got to wait for the 120 to come in. So, you know, that's cash flow. So I think often that disparity, people don't understand what a P&L is, you know, and what a cash flow is. And that can often be quite a head scratch for people to get around. And I think it's the bit around the VAT bit often that confuses people.
Yeah. So there's, you know, with phased payments, and particularly now you'd mentioned that, Mark, there's often a disconnect between seeing that number and thinking that therefore that's there. And it isn't, and it often isn't. You know, you might have 4-phase payments for that particular example from an agency point of view. So, you know, the way that float works is that it splits that apart. So you're actually seeing when a particular payment will land in real time. And because it's connected with your accounting software, you can see when it's physically being paid, and that reflects directly into your cash flow forecast.
Great, thanks guys. There's one final question here. I think it might be helpful for Leigh or maybe Hannah to come in from an expenses perspective firstly, and then maybe Mark. But it says, what KPIs are useful to monitor in terms of cash flow?
Shall I go first if they're still debating?
Yeah, give them a moment to think about it.
Yeah, it's a pretty broad question there. So one of the things I would be thinking about is looking at your budgets and what you've decided you want the year to look like, and then thinking about how you're actually doing against that. And so you can use things like float, of course, to be looking forwards and thinking about what you want the world to look like, and you've got your sort of your Armageddon forecast, I guess, in there. But it's really important then to stay on top of that. And what we can do with Soldo is take certain, I guess, hot areas on that forecast, or areas that you typically tend to overspend, and then create a ring-fenced almost account for that can sit inside of Soldo, so you can proactively manage that spend going out. So that's what I'd suggest from a spending point of view, is just really putting a bit of a ring around certain money that you know can be a bit risky, and making sure that you're putting some barriers in to stop it flowing out of the business unnecessarily. So that's what I'd be looking at in terms of KPIs. I guess the actual KPI for that would be actual versus variance on your budgeting reports. Does that help? Does that answer the question?
Definitely. Is there anything you wanted to add in there, Mark?
Yeah, I think there's 3 things that should be on a dashboard for the sort of liquidity side as a minimum. One of those is what Cheif will help with, and that's the debtor days. You know, most in the agency world, if you're getting under 40 days in terms of your debt recovery, you're doing pretty well, to be honest. So that's something I would definitely have on the dashboard. The second one, there's no particular order, by the way. The second one would be what I would call cost coverage. So the cash at the bank at the end of the month divided by your break-even costs. So whatever your overheads and so on are, I would keep that monitored. I mean, some people I know have got 6 or 7 times their costs in the bank, which obviously is a great place to be at the current time for a lot of businesses, but depends what the business vision is. You know, if you're trying to grow the business, perhaps that's too much money in the bank. And then the third one, which is my favorite of all time, is the current ratio. So I always bang on about this. I think I'm going to get a name for myself on this one. So that is looking at your balance sheet. So your balance sheet, as you probably know, is a snapshot in time of your assets and liabilities. And that ratio is your current assets, your debtors, your cash, for example, divided by your current liabilities. So your suppliers, your VAT, your PAYE, expenses, directors' accounts that are all due in less than 1 year. And if that ratio's over 2.2 to 1, you're in quite a good place. If it's less than that, it's a bit tight. If it's less than 1, you've probably got cash flow problems. So for me, that's from a board sort of level, that's the main one I would like to see, because you can pretty much tell quite quickly if the business is in a good position or not, cash-wise.
Cool, thank you, Mark. And a nice note to end it on as well. We've had someone in the chat box called Justine saying, I'll shout out for Agencynomics.
Planted.
So it looks like that's everything covered now. So thanks for all the great questions, everyone. And a big thanks to our panelists today. As I said, you'll receive an email with the webinar recording either this afternoon or tomorrow morning. So do keep an eye out for that.
Thanks, everyone.
Thanks, everyone.
Thanks. Bye.